Last lesson, we have examined the payoffs of the caplets and the florets. Now let's see how they are related to the options on zero coupon bonds. Consider a caplet on the M-day LIBOR with strike rate X. Let the notional principal be $1 for simplicity. At expiration, if the actual interest rate is R, then by the previous analysis, the caplet pays the following amount. Substituting in n equals to $1, we get the following compact expression. Let alpha be 1 plus x times m over 360. Consider alpha puts on the M-day zero coupon bond with a strike price of 1 over alpha and identical expiration date as the caplet. Then the payoffs of these puts is given by alpha times the payoff of each of the put. Note that zero coupon bond is sold at discount. Hence, at expiration, with the prevailing interest rate R, the spot price of $1 per zero coupon bond is equal to 1 over 1 plus R times M divided by 360. Rearranging the expression, we get the total payoff of these puts equals to the payoff of the caplet with $1 principal and the same strike rate X. Thus, a caplet can be considered as equivalent to alpha puts on the M-day zero coupon bond. Similarly, a florlet can be shown to be equivalent to alpha calls on the M-day zero coupon bond with the same strike price. Therefore, a cap is a package of puts on zeros, and a floor is a package of calls on zeros. Next, we'll talk about options on interest rate futures. The most popular exchange-traded interest rate options are those on Treasury bond futures, Treasury note futures, and Euro-dollar futures. These options are American-styled with prices quoted as a percentage of the principal amount of the underlying debt instrument. Exercising such options will mean the option holder taking a long position or short position of a futures contract of the underlying debt instrument. First, let's introduce the options on Treasury bond futures. An option on T-bond futures is an option on the futures price of the hypothetical 20-year 6% T-bond. The size of the contract is $100,000, or 100 points, with each point being worth $1,000. Prices are quoted in number of points and multiples of 64ths of a point, each 64th being $15.625. T-bond futures options cease trading in the months before the delivery months of the underlying futures contract. The following table is a list of quotations of both call options and put options on T-bond futures, with strike prices ranging from 159 to 162, and expirations in April, May, and June. As an example, the call expiring in May with a strike price of 161 is quoted at 4-18. That is 4 plus 18/64th point. Since each point worth $1,000, this, in dollar terms, is equivalent to $4,281.25. Here's an example. An investor is holding a June call for T-bond futures with a strike price of 159 after having paid 5-51 for it. Determine the net profit if the T-bond futures price rises to 165-0 and the investor exercises the call. Here, the profit is taken to be the final cash inflow minus the initial investment. Since the final T-bond futures price is 165 and the call strike price is 159, there is a gain of 6 points. Subtracting the initial investment of 5 and 51/64 points, the investor has a net gain of 0.203125 points, which is equivalent to $203.125. The options on T-note futures are similar to the options on T-bond futures. The 10-year T-note futures option contracts have a face value of $100,000 and a tick size of 0.64 of a point. However, the 5-year T-note futures option has the tick size of 128 of a point. Both options cease trading in the months before the delivery months of the underlying futures contract. Finally, let's introduce the options on Eurodollar futures. An option on Eurodollar futures is based on the quoted Eurodollar futures price. Quarterly Eurodollar options expire at the same time as their underlying Eurodollar futures contract. Serial Eurodollar options expire a month or two before the expiration of the underlying quarterly Eurodollar futures. For example, the underlying of the April serial option is the June futures. Like the underlying futures, the size of the contract is $1 million. The tick size could be 1/2 or 1/4 of a basis point. And the strike price could occur in intervals of 12.5 or 25 basis points. This table gives a list of quotations of both calls and puts on Eurodollar futures, with different strike prices and expirations. As an example, the call expiring in September with a strike price of 99.5 is quoted at 7 basis points. Since the contract size is $1 million and the Eurodollar futures is standardized to 90 days, the equivalent dollar terms of 7 basis points can be calculated as follows, which is $175. We use the following example to illustrate how the payoff of a Eurodollar futures option is calculated. Consider a 3-month put on the June 2015 Eurodollar futures contract at a strike price of 9,912.5. The expiration date of the put is in May 2015. Determine the payoff function. Let capital F denote the futures price of the June 2015 Eurodollar futures at the expiry of the put. Then the payoff for this put is given by the following formula. As a summary, in this lesson, we first showed that the payoffs of the caplets and florets are equivalent to that of the puts and the calls on zero coupon bonds. Then we examined options on interest rate futures. And that is the end of this chapter. Next chapter, we're going to study the value at risk.